Nice to see you all pre-Diwali. So you've seen the results, strong performance across businesses, and even within each of the businesses, the quality of numbers has just been improving quarter after quarter. And when you look at starting with Jio, with 18% growth in EBITDA on the back of strong customers, both mobility as well as homes. So here the point here is not about just customer addition, data usage, products that are on offer. So when I talk about quality, I'm referring to a lot of this and a lot of these factors, and Anshuman will take you through in detail on some of these. So resulting in EBITDA margin expansion. Retail, this is something I know you all have been tracking. Overall EBITDA growth at about close to 17%. In fact, revenues have been higher, but about 18%. And this is when you look at the categories, both fashion and lifestyle, grocery, electronics, all of them have seen anywhere between 17 to 23% increase in terms of year-on-year growth. FMCG continues to do well, and that is, now with 5,300 crores, effectively double. The NCLT approval, has come through. So this is something that the demerger will happen in 1st November, but we are waiting for, the written judgment on that one. And here, clearly the focus is on brand building, on bottling capacity, on setting up of the food parks. Media, and Kevin will talk through, but very impressive set of numbers with 400 million MAUs that we have, and a sharp jump in EBITDA too. Energy business, that's something that everybody has been tracking. Good numbers there, 21% higher, on the back of a lot of things, but primarily coming from the increase in cracks across gasoline, gas oil, as well as ATF. And some of the factors about ethane, light feed cracking, all of them coming in, in terms of contributing. Volume increase has been there, and so on. Domestic placements have been high. Again, both gasoline and gas oil in terms of throughput through the domestic markets up 34%. Upstream has been more stable at about 5,000 crores of EBITDA. A little bit lower on account of production, coming down as part of natural fall in terms of field performance. And on the new energy side, we continue to, we are on track in terms of both the panel production, in terms of being ready with the first line for sales, as well as the important one in terms of development of cut, so that RERTC can be generated from sometime next year. So these are numbers, when you bring them together, you're talking about 10% increase in revenues on the back of the jump that we saw in retail. And this is despite oil being lower. As you know, oil prices were lower. Overall EBITDA 50,000 crores plus, it's about 15% higher on a set of big numbers. And when you look at it on a PAT basis at 22,100 crores, this is pre-minority numbers, it is up, that is also up 14%. So this is despite finance costs being higher by about 14%. This is despite depreciation up by about 12%. And really, both these numbers are up because of the 5G capitalization that happened, and therefore the spectrum interest, etc., now flows through the P&L. And when you look at the 22,000, the big numbers in terms of PAT, standalone RIL is about 9,200, JPL at about 7,400, and RRVL at about 3,400. All of them, as I said, a good set of numbers. And this is just the EBITDA split, but you can see what I had summarized. Oil to O2C about 21%, E&P slightly lower, digital services up 17%, and retail 16%. And with media and others at about 10%, bringing to 14.6%. So as you can see, all the key, all the businesses have done well. As I emphasized, you can see in each of the, as you will see in each of the presentations, the quality of the numbers are just getting better and better and better over the years and over the quarters. So that gives tremendous stability to the earnings. And then, finally, when you look at the just the balance sheet, net debt broadly flat. The capex that we spent at about close to 40,000 crores, almost in line with our cash profits. So overall, strong performance and continuing strength in the balance sheet. And I'm going to request Anshuman to present the Geo section.
Hi, good evening, everyone. So Geo update on the results. Before I do that, I wanted to bring the attention to the fact that we are operating as a next-gen technology company at scale. We've spoken about this in the past, but every quarter we've been proving, doing new things and demonstrating our ability to develop technology and implement technology at scale. Indigenous technology, we have our own proprietary 5G stack and fixed wireless stack that we've spoken about in the past, and which is now working at a significant scale, at global scale. 3,400 plus patent applications across 5G and 6G, where we are among the thought leaders now across international forums. We have built several digital services for India at scale, and not only built but deployed, and people are enjoying those services and those platforms. Enterprises are using those platforms at scale. Our ability to operate at population scale, once again, over 500 million consumers that we hit in this previous quarter. We closed at 506 million homes. We've crossed 22 million and growing rapidly. Enterprises, which segment also is growing fairly rapidly. So we've got these platforms and technologies or solutions which are working at scale across all of these categories, and we keeping or developing end-to-end control over the value chain, and which will help us, which has already helped us in keeping the cost in control, keeping the whole development cycle in control, being able to bring out new functionalities at an agility which is better than what you see global operators being able to do, and taking this full stack approach, which also helps us now possibly taking some of these technologies and platforms to other places as well. So that's a theme that we're very focused on and we've been working on, and we've demonstrated that repeatedly, and we're continuing to demonstrate that across our business at scale. All of which gets us market leadership in mobility and home solutions. Number one in connectivity, 506 million subscribers at the end of the quarter, 8.3 million net additions during the quarter. Our chairman announced the 500 million subscribers in his AGM speech towards the end of August, and we have been growing since then as well. 234 million of these subscribers are 5G users, 21 million net additions in 5G users in this quarter as well. On homes, we've been making fairly steady and rapid progress. 23 million fixed broadband connected premises, 3 million net adds in this quarter. So our million a month kind of run rate has sustained over a period of time, and it's now picking up more. And out of these 23 million, 9.5 million are Jio Air Fiber homes using different technologies that we have spoken about, and which makes us the world's largest fixed broadband service provider, wireless fixed broadband service provider, bigger than Verizon and T-Mobile, which have had a much earlier start. All of this translates into market leadership in financial terms as well. 36,000 crores plus revenue, 45% of revenue market share in the connectivity business, 52% EBITDA margin for JPL. Of course, the connectivity business has a much higher EBITDA margin. So strong quarter with 18% year-on-year EBITDA growth and sustained leadership in connectivity. On mobility, one of the interesting things that we are observing is the uptake in data consumption and traffic in the non-urban areas, basically tier 3, tier 4 rural areas. Pan-India 5G site traffic has grown 2x in the last year, but rural sites have shown higher growth. So the uptake is actually quite healthy there, which is very positive for us because one, that shows that there is demand coming in from all geographies, all places, all segments of customers, and who are now consuming more and more. So devices propagation is penetration is better, and they're finding use cases to use the 5G. And two, in many of these areas, we are really the only 5G service provider at this point in time. So we have a healthy lead in that sense as well. On the network technology side, we have with such high 5G consumption, both on the number of subscribers and the data consumption itself, we have clearly demonstrated the most efficient use and most productive use of spectrum that we have got. Average 5G productivity is 3x higher than the LTE on 2300 band. That much more, we are sweating the spectrum and the assets that much more. Our 5G customers are enjoying 1.5 times faster data speed than the nearest competitor. And this is leading to more than half of the network data traffic now, wireless traffic now coming in from 5G. And this number is growing fairly rapidly. If you see the trend on the right, which is of 5G subscribers that we have on our network, it's growing fairly rapidly. In fact, most of the new devices now, it's 85, 87% plus new devices getting sold are 5G, and these consumers are using 5G services right from the start. So that trend is fairly healthy and continues to grow. The initiatives that we're taking to continue to grow our wireless subscriber base more, mobility subscriber base, a lot of customer campaigns that you would have seen in the last quarter, bundle offerings, anniversary and festive offers, IPL offers. So just giving customers more value for their buck, which we have always done, and we are continuing to provide that. Jio Bharat as a companion phone on our LTE network with a whole bunch of new security functionalities that we built in. We demonstrated that at the IMC earlier this month, and which is becoming quite a hit. People are, there are functionalities like allowing only certain numbers. A customer can choose to allow only certain numbers to be able to access on that particular mobile. Parental control, or these days it works the other way. You can control the device that your parents are using. You can control the numbers that are able to access that and try and prevent fraud. And that's a fairly popular functionality where you can actually, through the network integration, control the numbers that can access a particular device. We have also done partnerships with OEMs to bring more devices at different price points in the 4G and 5G segments. And that's something that you'll hear more of. We're still trying to penetrate, convert almost 225 million or maybe 215 million 2G users and upgrade them. So working on bringing more devices that are more suitable and affordable for them. And then at the same time, expanding the products and services. Our 5G SA has enabled us, or is enabling us to provide a few functionalities which only we can do on our network at this point in time. Of course, ultra low latency, but things like URSP, so route selection for a particular UE device, which we are now working with some OEMs to enable better quality of service on their devices. PPDR, which is working with the government agencies on public protection, disaster recovery. So some of these are functionalities which our 5G SA network is enabling us to do. Some of these are getting monetized, and others will get monetized over a period of time. And then, of course, bundling all of our digital offerings along with the connectivity. On homes, we are driving digitization of 1 million homes every month. So if you see the run rate on the chart on the right, that's picking up fairly steadily. And we expect that trend to continue. In fact, if anything, keep growing with our wireless broadband offerings that we are able to connect homes with much faster. Almost 1 million homes, new homes got connected every month in this quarter. And we extended our global leadership with a subscriber base of 9.5 million on wireless broadband. So Jio Air Fiber, which is a combination of both offering services on the 5G network as well as UBR. And both have been fairly steady. The quality of service has been as good, if not better sometimes, than FTTH. And I only say not better because fiber still gets cut. Here there is very little disruption. These networks run at almost 99.99% availability most of the times. And then set-top box as a gateway for discovery, which is what we're providing to every home. And a whole bunch of integrated experiences. I'll just cover that in a bit. And in terms of growth initiatives here, converting more or connecting more homes, there has been, we're seeing a lot of latent demand. every new area that we are launching our services in, and now the air fiber services are available pan-India, there is massive adoption. And with some of our, One Geo offering, which basically provides connectivity along with all of the content and security solutions, etc., there is a lot of demand coming in from there. We are now able to provide 1 Gbps connectivity, as we spoke about this in our AGM. Any user can get connectivity of up to 1 Gbps in 24 hours in almost the entire country. I think pretty much the entire country, wherever we have mobile connectivity. And then adding more products and services. Set-top box, an important one that is becoming a digital gateway. We've also now developed something called TeleOS, which is set-top box equivalent on the TV itself. So all of those features, functionalities which come through a set-top box, through our tie-ups with OEMs, we are able to provide those on the home screen. So you don't need the physical device, but of course we have the physical device, the set-top box also available wherever needed. And then offering GeoPC, gaming and content, a few of these offerings which are now being rolled out or have been rolled out and are becoming more popular on the field. TeleOS, GeoTeleOS, which is our own operating system, which is what we use for the set-top box. And now we have basically made it into an operating system that other OEMs can work with, and we already have some OEM partnerships where they're using the GeoTeleOS in their TVs. It's getting embedded, and which enables replication of the set-top box. Really, you don't need the external device. It's all of those functionalities are coming in the TV itself, be that OTT and live and catch-up TV, all the OTT content that we offer on the set-top box. GeoPC, which we have now launched, which is in the beta phase, and many of you are Geo home fiber or air fiber users must have seen that on your set-top box. That's live, and the uptake has been quite remarkable, and the experience has been quite remarkable. The minutes of usage is growing almost every month. We are seeing dramatic increase in the number of minutes of usage of that. GeoStore, which gives an opportunity for other developers to come in and offer their apps and on the OS itself. Security, home automation, and parental control are all functionalities which have been built into the GeoTeleOS and which can get integrated with the service. For the enterprises as well, the One Geo approach, a combination of both connectivity and products, where now we've spoken about this in the past as well. Our focus is getting more revenue pools coming in from the enterprises beyond connectivity, and almost all, it's not yet 100%, but almost all of our large enterprise customers are taking more than one service from us. So it's not only connectivity, it's connectivity plus a bundle of services. So the managed services stack is what we are offering them, including connectivity, managed Wi-Fi, compute, security. Our Geo Cloud is becoming quite popular with the enterprise clients, Geo Cloud telephony. The pan-India network and being able to provide them connectivity now with our UBR offering or Geo Air Fiber offering, we are able to connect any premise, any enterprise at 24 hours and through a common unified interface for the customer. And this is, Gbps level connectivity. So we are able to offer this, which again, we are fairly uniquely positioned to be able to offer this. And when it comes to SMBs, this becomes quite important for them to have a single interface to get all of these services and connectivity through the same service provider. And then we are doing partnerships and tie-ups with other service providers as well as we take our services to the consumers. And we've been expanding our market share. Of course, this is, as you all are aware, this takes longer to break into enterprises, but we have segments like the BFSI or hospitality where we clearly are the market leader now, and increasingly in some of the other segments as well. A few other launches in recent times, the GeoPC, converting any TV or screen into a computer, cloud computer. Now again, most of you by now would be familiar with this product itself, and many of you may have used it or have got it in your own connections. We have now launched this. It's still beta, so we are not really charging customers for this, and we are trialing it. The pickup has been very healthy. We are including functionalities in this where users can actually buy capacity, compute capacity based on their requirements, for certain periods of time, so they don't need to have very high processing speed or processor capacity. If they don't need it, they don't have to pay for it, and they can buy it for whenever is a requirement. We are integrating it with the Jio Workspace, so they get everything, all of the office functionalities on their cloud PC. We've also tied up with some of the partners, service providers, where we are able to offer more software through the Jio Cloud PC. So for a consumer, there is no difference between this, or there is no difference between what this cloud PC can give them versus a traditional computer. But of course, this is far better because you can optimize, you can pay for only what you need to use, and the upgrades are automatic. You don't even have to go and buy a new computer. So this is something that we are very excited about, and the initial feedback from the market, from consumers, has been very, very positive. GeoFrames, you have seen this. We have developed using our own complete hardware and software stack, our own AI. It is, the hardware also has been developed by us, has been optimized by us, and is getting manufactured in India. The OS, of course, is our own, multilingual. We are already supporting 10 languages. We should be supporting 12 languages fairly soon. The price points are significantly below where the global companies are today offering their products. You will see these coming into the market in the next few months at price points which are very suitable for the Indian demand, Indian requirement. That's been the effort that we are working on. We'll have some models coming in reasonably soon, but the mass scale models should come over the next few months. Coming to the results now of the connectivity business. The total customer base, as I said earlier on, went to 506.4 million. That was a net add at 8.3 million in this quarter. So we're seeing fairly sustained growth there. ARPU at 211.4. That continues to grow steadily. In fact, the increase from the 195 to 211 is post the tariff hike of last year. So this really has been coming mostly out of increased usage, plus some of the 5G upgrades that people are doing as we keep launching, keep nudging consumers to move to higher unlimited 5G plans. Total data consumption on the network has gone to 58 exabyte, per capita data consumption at 38.7 GB per user per month. The operating revenue for RJIL came in at 31,857 crores in this quarter, which was a fairly healthy 12.4% year-on-year growth. EBITDA came in at 17,874 crores, which is 17.4% growth. EBITDA margin expanding to 56.1%. So all in all, fairly good growth. The operating leverage is playing out quite well, and we continue to see healthy margin expansion in our connectivity business. For Jio Platforms consolidated business, consolidated financials for Jio Platforms Limited, the operating revenue was at 36,332 crores. EBITDA increased 18% to YOY to 18,757 crores, and profit after tax at 7,375 crores, 13% growth year on year. So again, steadily increasing the contribution of non-connectivity business, increasing in every quarter, including from a whole bunch of new services that we are offering in the market. The digital services are getting monetized. So that growth rate has been fairly significant. Moving on, I have a brief section on our AI announcements that we made in our AGM speech end of last month. Our playbook for the AI, well, we've got all of the components, ingredients that are needed to really bring the best AI services, products, solutions to the market, both for enterprises and for consumers. We have, of course, the go-to-market reach and customer access in connectivity, understanding of consumers and enterprises that Jio brings to the table. We have the global partnerships, strategic partnerships, access to models, access to technology and resources from most of these large AI companies. We have, within Reliance Industries, we have the capability to build the infrastructure, the power, which is really needed to put all of the AI infrastructure in place. And in Reliance Intelligence, we have created a company as a 100% subsidiary of RIL, which will utilize all of this, which will invest in developing AI capabilities, infrastructure, and then build solutions and products and take them to market through Jio or through the other ecosystem companies that they've got. We've already made a lot of progress here. Some of our products already integrate a fair bit of AI that is homegrown, of course, using GeoBrain and integrating with the leading products and models of other service providers, and doing some of that ourselves, and building products and services for the entire consumer segment, plus also SMBs and enterprises. So the partnership with Meta, a joint venture that we have formed in Reliance Intelligent, is 70-30 partnership. That's been formed to develop solutions for enterprises, for example. We'll do similar partnerships with others as well, not joint ventures necessarily, but partnerships. And similarly, we are developing products for the consumer segment. Now, all of this will go to the market through Jio, because Jio has the access. Jio knows what the customers are using and are looking for. So it's a fairly synergistic play between all of these ecosystem players coming together and developing the best of AI for Indian consumers and Indian enterprises. And that includes AI DC infrastructure that we're developing in Jamnagar, that we have announced gigawatt scale DC in Jamnagar. We have already announced a GCP region, a cloud region in Jamnagar, working with Google, which is going to be powered by 100% RIL green energy. It's going to be fairly unique in that sense to have access to so much of green energy in that one location. AI model capabilities, we're working with partners. As you're aware, some of our tech partners already are doing cutting edge work in AI, and some of the other companies as well, and we are collaborating and working together with them. AI for consumers, some of our products are coming in the market or are already utilizing this, be it on some of the things that you see in MyJio or Jio Hotstar. These are already getting integrated into those apps that consumers are actively using. And then developing AI for sovereign use cases and for enterprises and SMBs. Now, this is a priority area for us at Reliance. There is a 100% subsidiary of RIL, which is going to be working just on this and synergizing and working together with all of the other ecosystem companies like Jio. The CapEx is going to be done here. The infrastructure is going to be built here. And whatever other kind of partnerships, access to compute infrastructure that is needed is going to be done here. The products and services that are developed go to market through our other companies, ecosystem companies like Jio, like our media business or retail. And that is where Jio plays a very critical role. And Jio benefits really with all of these products and solutions which are developed. And Jio continues to have the flexibility to work with other service providers as well. So it doesn't only have to work with Reliance Intelligence. Of course, if Google and Meta and OpenAI bring in more products, Jio can go and collaborate with them as well. Slightly longish today, but that's the end of my presentations. We'll take the Q&A later. I'll hand over to Dinesh now.
Hi, good evening, everyone. We had a very strong quarter. We delivered 18% growth on a YOY basis. I think this reaffirms the resilience of the business model, and all the engines are firing. If you look at growth across consumption baskets, so all our major consumption baskets have grown strongly. Online channels also continue to grow well. We are quickly scaling up our quick commerce offering pretty aggressively. We are also scaling up our store footprint as well. We added about 400 plus new stores during the quarter. If you look at all our operational metrics, number of new customers added, number of transactions, all of those have a pretty healthy trajectory. If you look at transactions, have actually grown at 27% vis-a-vis revenue growth of 18%. That is because of the significant growth coming from the online channels. We made a public commitment and implemented the changes to pass on the GST benefit to consumers immediately once the new GST rates came into effect. It was done very seamlessly and very clearly and transparently communicated to customers. We continue to add new partnerships into our business. During this quarter, in our premium brands business, we entered into partnerships with two very global marquee brands, Stella McCartney and Max & Co. If you look at our numbers, gross revenue up 18%, net revenue is up 19%. Slight difference because in the last week, the GST rates came down. EBITDA from operations is up 17%, same as total EBITDA, and same growth rate for profit after tax. Grocery, that is the biggest consumption basket we have. We have 3,500 plus stores across the length and breadth of the country. We continue to leverage that footprint for omni-channel expansion. If you look at most of the tier 2 and beyond cities, when we enter, we are the first modern trade retailer in those geographies. We introduce modern retail to a significant part of the country. We also are leveraging that infrastructure to offer omni-channel capabilities to customers, omni-channel offering, where the entire store assortment is available with quick delivery to the home as well. In the bigger cities, we are also complementing our store network with dark stores so that we reduce the last mile delivery radius, and we're able to deliver that quickly. Another interesting trend that we are seeing is the premium formats are growing significantly faster, while we are seeing strong high single-digit LFL growths in our big box stores. The premium formats are actually clocking double-digit growths. Similarly, Metro, which is our B2B business, that again continues to be on a very strong trajectory with growth coming from multiple categories. We continue to have engagement with the Kiranas and grow our share of wallet with them. JioMart, we are quickly scaling up our quick commerce offering, which is now available in 5,000 plus pin codes across 1,000 plus cities. We added close to 6 million new transacting customers during the quarter, which is up 120% on a quarter-on-quarter basis. Our quick hyperlocal deliveries continue to be in a strong trajectory with 42% growth on a quarter-on-quarter and 200% growth on a YOY basis in terms of average daily orders. To complement our 1P offering, we continue to add new sellers so that we provide the entire range to customers. We have also started quick commerce for electronics and accessories. In fact, we are also doing it for fashion. In electronics, we have our stores, a large part of our stores which have been enabled on the quick commerce network, where the entire grab and grow assortment is available on quick commerce for 30-minute delivery within top 10 cities. We are also now aggressively investing behind brand building and create awareness of our very strong proposition, which is unmatched prices, convenience, and no hidden charges. So we basically promoted the a campaign with MS Dhoni to leverage the demand for the festival season. Fashion business also had a very strong quarter with very strong LFL growths. The new formats, Azort and Yusta, they continue to scale up very well. Yusta reached the milestone of 100 stores with a significantly large number of stores which are in the pipeline and will become operational in the next 2 quarters. We have also kind of focusing on the ethnic wear category for the festive period. Also focusing on giving customers a complete look, because customers, when they come to a store, they are looking for everything, not just apparel. And for us, that helps improve our average bill value. So in addition to apparel, footwear, beauty, accessories, imitation jewelry, those are all categories where we are enhancing our offering, and their share is increasing quite meaningfully. Ajio, our online fashion business, had again a very steady quarter. We've been focusing on premiumizing the offering, add more and more exclusive brands, as well as other international brands into the portfolio. And as I mentioned earlier, Ajio Rush, which is the quick commerce offering in online, that we have made available in 300 plus pin codes across the top 6 cities. And the way it works is you basically have a curated premium assortment, which is available in those particular pin codes. And if the customers order that, it gets delivered within 30 minutes. The benefits of that is, as you know, quick commerce online has the highest returns. So the returns on Ajio Rush are significantly lower. The ASPs are significantly higher because the assortment which is curated is more premium in nature. It's a convenience service, and the conversions are much better, right? And in the pin codes where we have made this service available, we see a very strong uptake, customer adoption in this service. Shein, which we launched a couple of quarters back commercially, we've crossed 6 million app downloads. Monthly active users are upwards of 11 million. We are now also starting to invest behind educating the customers about the relaunch of Sheen, because now we have a significantly large portfolio of almost 25,000 plus options which are live on the platform, and every month we continue to add new options into the portfolio. On the premium brand side, as we spoke about, we entered into partnerships with Stella McCartney, which is a conscious luxury ready-to-wear brand, and Max & Co, which is a youth-oriented women's ready-to-wear brand. There are quite a few other exciting partnerships in the pipeline as well. Our beauty business, which is Sephora and Tira, continues to expand pretty aggressively. We launched Fenty Beauty in India in the last quarter. We are further expanding our presence significantly in Tier 1 markets. On the jewels business, as you know, gold prices have gone up significantly over the last quarter and even before that. As a result, the average bill values are up pretty substantially. Now, what has happened across the industry is that volumes have gone down because purchasing power has been impacted because of the significant increase in prices of gold. So the growth has been steady. I think as the gold prices stabilize, the growth will, again, the volumes will also pick up. Another interesting thing which we are seeing is instead of investing more in new gold, the share of exchange has gone up substantially. So it used to be about 22% earlier last year, which has now gone up to almost 33%. So people are basically recycling gold rather than investing in new gold because of the increase in prices. On brand building, we have launched a new collection with Raveena and Rasha, and then campaign is up and running. We are looking at that to capitalize on the Dhanteras buying which will happen. Electronics business again had a very strong quarter with very strong LFL growth. There was some impact in the time period between the announcement of the GST rate reduction on select categories and the actual GST rates came into effect on 22nd September. So during that interim period, people deferred. These are all high ticket purchases, so people deferred their purchases. So there was some impact of sales, but after that the pent up demand picked up pretty well, and that has continued into the festive season. We had a very strong Independence Day, as you know, is a big, that week is a big week. During that period, we had almost 24% growth over last year. Rescue, which is a big differentiator for us. We are now present in 1600 plus locations. So we are offering the rescue services, expanding it along with our store footprint, and it has a pretty wide presence now. Our own brands business, we are tapping the overseas market in partnership with local in-market players. Also, we are strengthening our offering with launching new variants in each of the categories. Our B2B and distribution business also had a pretty robust performance. It continues to be dominated by mobile phones and TVs, and that itself, there the focus is on increasing the width of distribution as well as the share of wallet of the retailers, which are both on an upswing. Quick on our FMCG business, 2x growth on a YOY basis for H1. Q2 was 5,400 crores of top line, so pretty strong growth. All our brands, the main brands are Campa and Independence. Both are seeing very strong market share gains, and as we are expanding the supply chain, the volume growth is pretty substantial. General trade contributes almost 75% of sales. We are doing a lot of on-the-ground activations to basically for the purpose of brand building and make the push through the trade channel. We've signed up several MOUs for food parks and looking up setting up manufacturing facilities across the length and breadth of the country. We've also acquired the brand called Velvet, which is a pretty old heritage personal care brand. This will drive our growth in the personal care portfolio. It has a pretty strong brand recall and customer loyalty. So we will be scaling up the product portfolio as well as expanding the geographic presence of this brand.
Thank you. Good evening, everyone. The last time I presented to you all was just after the IPL that was there. And with the IPL came an influx of a huge amount of audiences. Our biggest challenge at that point of time is how do we convert these audiences to remain on the platform and watch our entertainment content. as Srikanth mentioned earlier, I'm saying is we have managed to have 400 monthly active users on this platform, and I'll tell you what we did to retain them. So if you look at it from the entertainment point of view, I'm saying this quarter for us was a lot of entertainment. Some of our biggest shows, I'm saying is what IPL is to cricket, Bigg Boss is to entertainment. Bigg Boss across languages has performed exceedingly well with a 54% growth in watch time across Jio languages. Two is, we had some of the best short series. Criminal Justice was what we had done last. I'm saying is, then we launched Special Ops. Special Ops turned out to be the second highest watched series on the platform, only to follow Criminal Justice, and remained number one for 4 weeks on a row. As much as we look at trying to see how we can come up with these huge tentpoles, one of the objectives that we have as for Jio Hotstar is to ensure that we have more and more engagement, and how do we get consumers to come to us on a daily basis, then come and watch us just on a weekend, or binge watch on a weekend, or just watch something which is dropping once a week, right? So our objective there is to try and offer them series which are 100 episoders. We did a highly successful one in Tamil Nadu, and this is something that we'll replicate across markets. Heartbeat was one of our top-rated shows, 100 episodes, and we had a drop happening every day. And we saw consumers coming to this platform for 100 days on a daily basis. And for us, that's something that we like to also pivot with to make sure that we have stickiness on this platform. Lastly, Q2FY26 Season 2 is what we launched. Happy to share with you that this show actually has been the biggest show across TV and digital, and our biggest launch in the last 5 years on the platform. Shown a 2x growth over the best ever show on Jio Hotstar. And lastly, for the premium audiences, we continue to be the go-to destination for any premium home in this country, only because each and every big American studio content is there on this platform. So that's entertainment. Talking about sports. Jio Hotstar actually has become the largest sports platform. It's not just cricket. Across sports is where people come to this platform. If you just look at it, we did the India-England series, and this series was one of the most watched test series on any digital platform till date. 170 million viewers with 1.1 billion viewership time for live cricket. But it's not only about cricket, right? What's more important for us is looking at all different sports. So if you see Wimbledon, Pro Kabaddi, Premier League, each of them have started showing substantial growth. Clearly, I'm saying is consumers look at this platform to offer them the best sporting events across. So that's from the content point of view. Just to give you a quick one on the operational performance. Sports, the 3 tournaments that we had, I'm saying is, which is India, England, Wimbledon, and the US, both of them, all 3 of them delivered record viewership and monetization. The ongoing Pro Kabaddi League, which is actually the second biggest aggregator of audience after cricket, has seen a massive growth of around about 148% year on year on watch time on Jio Hotstar. On the digital part business, as I mentioned earlier, we maintained 400 million monthly active users, reflecting user stickiness, and that's how we have managed to convert viewers from cricket to entertainment, and I shared with you the content lineup that we had to do that. Our entertainment watch time was poised to grow by 10% quarter on quarter. And last, our digital ad sales has seen a really solid trajectory, led by connected TV, where the revenue is much higher than mobile. Lastly, on the linear business, again, we operate a very big linear network in this country, and we continue to push it hard. Our entertainment viewership on the linear channels has grown by around about 30 basis points to 34.5. But what's more important, it is close to the combined, I'm saying our viewership is actually close to the combined viewership of the next 3 networks put together. Lastly, I'm saying is the linear TV ad revenue has shown a double-digit growth quarter on quarter, despite the challenging macro environments. On the financial front, we've had a record EBITDA performance with industry-leading margins in a challenging micro environment. If you look at our EBITDA margins, 28.1%, which is really gold standard within entertainment, within the media world. Our revenue of 6,179 crores and EBITDA, which has grown quarter from 1,000 to 1,738, and profit after tax of 1,326. Yes, this was in the back of one, I'm seeing is keeping a cost control on costs, but more important, strong performance from both subscription on TV as well as on digital. Our digital ad sales has had a really strong growth. TV entertainment sales continues to see pressure, mainly because of FMCG having major cuts. But with the GST, we are seeing green shoots, and we expect the quarters ahead to be much better. Maybe a sequential comparison might not be right because we had, from a revenue point of view, because we had the IPL in the previous one. But in spite of that, we've had a robust delivery on revenues. Thank you.
Good evening, everyone. Just to do a recap of the quarter gone by. So, as you can see, it's slightly better, pretty much flat, but slightly better than in terms of EBITDA quarter on quarter, lower year on year. Again, this is because of the natural decline in the KGD6 fields. Again, like I mentioned last time, the natural decline is a lot less than what we had envisaged. And over time, the sense is that the resource base is a little larger than what we had anticipated at the time of the field development. Consequently, we have been working on options of augmenting production from these fields. So we have got a deepwater rig come to our block in the next quarter, in the next year, the first quarter of next year, and drill wells. So we'll have some exploration wells, which is more infrastructure-led exploration wells around the existing infrastructure that can be tied back rapidly in case of discovery. We are looking at sidetracks to extract more reserves in the MJ field, as well as additional wells in the R and SAT cluster wells to create more reserves. Again, these can be tied back rapidly in the most capital efficient way. So those are things that we are working on whilst we see this natural decline in KGD6. In CBM, the production should have been better, except, we are trying to drill the multilateral wells rapidly, but because of the adverse weather conditions, it was a roadblock in that sense. So the expectation is we'll be able to rapidly drill these wells in the coming quarters and augment the production. In terms of price realization, again, year on year, it's been higher, just that the ceiling price was also about $10.04 at this time. $9.72 at the current juncture. So overall, when we look at this decline, our focus is now how do we augment this decline. And as you can see, it's in KGD6 that we see it. But then we have identified accumulations and reserves in and around those fields, which we intend to accrete rapidly and augment production. Just to get a sense of how the gas prices are, as you're all aware, the ceiling price was notified, and it's $9.72 in the half going ahead. And we expect overall prices to remain range bound. I mean, largely what's happened globally is that the China demand has come off by almost 16% in the last quarter, whereas US LNG exports have gone up by almost 20%. The only thing that's held up the prices is essentially the political turmoil that we see still in the Russia-Ukraine scenario. But nevertheless, what we see is fundamentally even EU inventories are still much lower than 5-year averages. So what we expect is prices should hold in this range. Now, since ceiling price is lower, we expect to max out on the ceiling price. So that's about $9.72. Indian market still remains robust. The demand remains robust, about 192 million standard cubic meters per day last quarter, up by about 3. Again, led by CGD, we still see growth in CGD, the fertilizer sector, but slightly fell off in the power sector because of the monsoons. But largely, the demand is not a concern at all in India. In terms of the availability of gas, that is the key piece, and there's a lot of effort that is underway right now. We are looking at expanding our presence in the east coast of India, along with our partners. So those are efforts underway, and in due course, once that happens, we'll be able to get back more accretion. That's how we're looking at it. Thank you.
Good evening to all. On the O2C financial performance, we can see that the revenue is up about 3.2%, EBITDA is up 20.9%, and the margin is up 130 basis points. The reason for the sharp increase in the EBITDA is because of the fuel cracks. Gasoline, jet and diesel all going up significantly, and the range has been an increase from 22 to 37%. We'll cover the details in a while. Improvement in the polymer deltas. PE is up by 6%, PP by 8% and PVC by 5%. Polyester chain, of course, has been weak. It's down by 9%. Another aspect of the good EBITDA growth has been domestic fuel placement through our JV partner, GOBP. Diesel sales are up by 34% and petrol sales by 32%. Also, we've done something on the yield optimization, which I'll cover in the next slide. That has helped also to capture the fuel margins. And we also have ethane as a feedstock where we could procure a little more quantity than normal. So that also helped in the profitability going up. If you look at the Q&Q EBITDA, it improved because of high fuel cracks already mentioned, but it was partly offset by the higher OSPs of the Middle East. Because of all the geopolitical tensions and concerns over supply going away from Russia, there has been concern, and then the differentials of most of the crude and all have gone up, which impacted the EBITDA to some extent. Now, how did we tap these kind of favorable cracks? We maximized the crude throughput within the same capacity, of course. How we did that was we optimized around blends and different crudes, ensured that always the utilization at the highest level in the crude unit. So instead of having 20.2, we've been able to take the throughput up to 20.8 million tons in that quarter. The other important aspect for the refining margin is the platformer, and which makes gasoline, as well as FCC, which is also helping in the production of more gasoline, as well as distillates. So these two units also were run at a higher utilization rate, increasing, the yield of valuable products like petrol and diesel. Also, PP goes up, so that is also one factor which contributes to the profitability. Aromatics, like I mentioned about the polyester chain. So what we could do with that was maximize our gasoline production. So we optimized around that so that we make more gasoline, which is more profitable. The fuel of a refinery is pretty important. It's a large component. So how do we optimize the fuel? So we try to cut the cost of fuel by increasing and maintaining a high level of gasifier operations where the coke is converted into syngas, which is used as a fuel, and also wherever possible we've imported cheaper power from the grid. So all these are the activities we've done too. They were good margins, but we had to go and tap those margins, and these are the actions that we've taken. I mentioned about the strong performance of GOBP in the domestic market. So if we look at the volume and the growth, which is in brackets, petrol and diesel together, we've done about 1.8 million KL. That's like a 34% growth. ATF, which is jet fuel, We've done about 157 TKL. Yeah, this is lower definitely than last quarter, but what is important to note is we're maintaining the share there. And all of you would remember that after the incident in Ahmedabad, all the planes became more cautious. They were doing a lot of checks and all. So there was a reduction in the traffic, which caused some of the ATF thing, to go down. E-mobility wise on a low base, but we've grown at 32%. CBG and CNG are an important focus for us. We've grown by 70%. Talking about the market share and the effectiveness, market share wise on petrol, we are at about 3.6%, diesel at 6.2%, and jet fuel or ATF at about 6%, close to 6%, 5.9%. Network, I think that's something which we are aggressively working on to increase our presence and footprint across the country and add more and more outlets. So we are at 2,057. Charge points for our, EV mobility solution, it is at 6,431. CBG and CNG stations are at 107. And convenience stores, because that adds to the non-fuel sales, that's about 142 convenience stores. So these are the reasons for the strong, I would say, performance of RBML, and we are continuing to work on this to improve further. We've seen that the crude prices, have been very volatile. All of you are probably seeing in the newspapers and reading about this. So quarter to quarter, of course, if you look at year-on-year basis, second quarter was of 25 versus second quarter of financial year 26. From $80, it's fallen to $69. And what was the reason? There were a couple of things. The reason for the fall in oil prices was OPEC Plus has been unwinding their cuts. They had cut production, and more than 2.2 million barrels of OPEC cuts have come back into the market. So that has definitely weakened the price. What has been holding it up from any further, slippage in the price is that geopolitics